All right, guys, we're live with Kevin Green. Sorry it took a second to get up. We have a bunch of stuff to upload to talk to you guys about today. A bunch of significant events have been happening in the market lately. Not to mention, just going over the basics. Let's go over the performance, and we'll go over the performance just year to date to keep it simple. Coco's now 112%. We got stopped out of that trade last week. Great trade, netting over 200%. Phenomenal trade, but however, all trends come to an end, especially in the commodities market. When they have a crash, that can be it sometimes, and maybe that's the end of cocoa. I wouldn't be surprised. I wouldn't be betting on a new uptrend here happening in cocoa. It really got kind of out of whack there, so let's see what happens. Copper's right behind that, 17% year to date. Orange juice, 16% year to date. Crude oil came back a bit, now 11% year to date. Silver is up 11% year to date, still holding nicely. Gold up 10%, just over 10% year to date. Lean hogs up 8% year to date. So, looking at these things, and let's look at over the last month, oats has started to really lead the way, which is very interesting. We've been trying to talk about that trade for a while, finally got that break out of that zone very recently. So it finally made a new high. Long oats at the moment. That's something that's an interesting trade because it's one of the smaller commodity markets. The contracts are pretty small. You can kind of get in and out of those trades pretty easily, even if you're a newer trader. So, that's something to look at. The ticker is ZO. And if you look at going back over the monthly reports, 1 second, it messed up my space. And then going over soybean meal right behind that. That's kind of interesting thinking of, corn up 5%, soybean meal up 15%. That's something that you usually see when the cattle markets start to have some weight on the cattle market, meaning live cattle, feeder cattle. So we might see some pressure on those markets at the moment. Feeder cattle is up only 1% for the month, and so is live cattle is up only 1% for the month. So Kevin, what are you seeing in the commodities markets right now? There's so much going on. Always interesting because we cover everything. When we're a commodities trader or a futures trader, everything's involved. You're looking at the macro, you're looking at bonds, you're looking at the money supply. What are you seeing, Kevin?
Yeah, seeing a lot, and I know that people are probably like, "Man, why is he never like looking at the start of this thing?" It's because I'm sharing, right? Which we all should be sharing, and then I'm also sending you another chart. But all right, so let's talk about the commodity spaces. Well, which one do you want to talk about first before we dive in?
I know you sent a bunch of good stuff, so let's start with right here. First thing you sent me is incredibly interesting, so let's talk about it.
Okay, all right. So, all right, this is like the number one hit here. So you're coming out swinging here. Okay, so this chart here. Let me not talk about the chart. First of all, we had a key development that actually happened. It wasn't last week that it happened. It was the week before, where heating oil. And when I say heating oil, we're gonna use that in the same sense as diesel. 98% of those two different products are for the most part the same. There's slight differences, but heating oil and diesel basically trade off the same contract. Okay, just that's why I have heating oil / diesel on there. So we had a very interesting development that happened 2 weeks ago where heating oil actually broke the 200-week moving average. 200-week moving average. Now, there's a lot of traders that may use 90-day charts or even like the yearly chart. Yearly charts are the 1-year charts, and they're fairly popular. But the perspective that you get from the commodity market when you're looking at the weekly chart or a monthly chart is really, really great, to say the least. It's not only that you're able to see seasonality and trends, but you actually also see some technical setups that kind of remain true for these contracts. Just like you would probably see for a stock, for the most part, there's certain moving averages that certain stocks can gravitate to or bounce off of. Well, for heating oil and for crude oil and for gasoline, it's the 200-week moving average that I'm always keeping my eye out on, because we rarely break through it, Jason. And when we do, it's usually not a good sign for the broader equity market. So I have the S&P 500 in white. I have heating oil in green. Okay. And we have the red line is the 200-week moving average. Now you'll notice every time that we break the 200-week moving average, we see equities selling off. And actually, heating oil and diesel is a really good leading indicator for the broader equity market as a whole. You can also say that for crude oil as well, but I like to use heating oil because of the transportation properties that it has, as well as the low amount of speculators within that trade, because people that usually want to trade energy, they just go directly to crude. So this trade's really on the fundamentals within the market as well as the technicals. Now, we had a breakdown here, and I'm going to go from left to right so we're all on the same page and know what we're looking at. So this is the max chart that we have for the contract itself, okay? When you're looking at this, one thing to just kind of note here, we have the, I'm getting my chart back up here. Oh, I sent it from this side. All right, so we're going all the way back, and this is going to encompass all the way, let's say, till 2004, okay? When you look at the first break that we had, when heating oil spiked to the upside in 2008, then crashed to the downside, the equity market was already on the slide, but that nail in the coffin is when we actually saw the amount of consumption just completely fall off the map when it came to energy, which is where we saw the flush when it came to the equity market as a whole, right? Instead of just a minor correction or pullback. 2008, 2009, 2007, we know exactly what happened there. We had another situation where we broke through the moving average, the 200-week moving average in 2014. Now, here's some context there. From 2014 to 2015, that is when OPEC and Saudi Arabia, it's basically Saudi Arabia, came out and tried to kill off the shale boom. You remember that? They've tried to flood the market. They push prices all the way to the downside, down to like $35 a barrel, $30 a barrel, what have you. And that also collapsed all of the byproducts while we still had a glut of inventory, and then as well as new inventory on the global stage hitting the marketplace. So that's where we see heating oil just dramatically drop. But the equity markets from 2014 to 2015, for the most part, held in there. But what happened right after that? 2015, 2016, minor pullback when it came to the equity market. When I'm talking about minor pullback, let's say 8%, 10%, 15%, what have you. A major pullback would be like an 80% move. We rarely see those type of situations. What also happened here? 2020, remember COVID-19? Well, the equity markets continue to move to the upside, right? But what did we see what happened with the energy products? They actually started moving to the downside because we saw the consumption trends starting to contract before the United States actually took COVID-19 seriously. Once again, a leading indicator, broke between the 200-week moving average. Equity markets also sold off, pulled back, okay? Equity markets recover a lot quicker than the energy markets do. But we had a test in 2023, last year, of the 200-week moving average. So I'm going to try to be very concise here. So what were we talking about, you and I talking about, when it came to the energy market at the end of 2023 in December, right? The opportunity for energy prices to move to the upside. This reflation trade started to come back into the picture. And we saw the positioning when it came to the commitment of traders. We know that the market, the speculators, were very short. But the key technical area that we were talking about on our first video that we ever did was also the 200-week moving average, and the fact that we rarely violate that average when you're looking at crude. We rarely violate that average when you're looking at heating oil. And knowing the fact that we were going to have greater consumption in this whole Goldilocks theoretical scenario here, it made it very unlikely that heating oil was going to break that 200-week moving average at that point in time. Because you can't have growth and consumption increasing without the raw goods in order to do so. Somebody that tells you difference, like a Goldilocks scenario, is lying to you. Now we actually have that official break. Here's the thing that I'm thinking about here, Jason, and I'll kick it to you here real quick. When you're looking at the operating rates for refined rates, they pretty much stayed between 87% and 88.5%. over the last, let's say, 2 months, 3 months. We had the move to the downside when it came to operating rates because maintenance season. We had some weather events, the Arctic blast in January. We've moved those back to the upside, but energy companies and refiners have basically kept these operating rates at the same clip. When you're looking at the product supplied or the input goods that are going into these refiners, we're seeing maybe a slight increase, but nothing that's like completely just shocking us, right? Maybe a couple, but it's nothing that's huge, right? Exports going up here a little bit when you're looking at the crude products. Speculators are getting out of that energy trade. No one's calling for $100 oil anymore. So if you have the product supplied hitting the market being the same, right? If you have the raw input goods going to those refiners for the most part staying in a range, then what are we missing? It's got to be either consumption is going down, it's not being reflected in the data, or speculators are completely off sides on the energy trade right now. And one of those two things has to correct itself in the next 3 weeks. And that's what I'm kind of looking out for. What I'm concerned about is if this is going to be a thorough break of that 200-week moving average when it comes to heating oil, then we see a further slide. And that could be an indication that the equity markets will actually see a pullback, a meaningful pullback here. And we could talk about the technical reasons as to why. Or speculators are completely off sides and they're about to be short squeezed, maybe not to the aggressiveness that we saw in December, but it could be something close. So I'm at a 50-50 chance right now. I am more leaning towards the fact that we might actually see a broader equity pullback in an economic slowdown rather than the fact that speculators may be off sides for the long term. That's what I'm kind of looking at today. I know I took a lot of time there, but it's very important that people understand this technical setup and the implications and the ramifications it could have on the macroeconomic factors that we actually look at. And this leading indicator is a really good one, and we had a significant violation. What are your thoughts on it?
Yeah, so I mean, there's so many ways to look at the energy market, and great bringing that up. Also, like Kevin said, guys, please feel free to share. Check out our YouTube as well. Most people are on Twitter all the time for this, but you guys can chat with us on YouTube. But when we look at oil, and also going back to January, we did talk about this, the reflation trade, why it was possible here. Go back to our first video. You guys can see us talking about it. You guys can see that we've kind of been pounding the table on the reflationary environment. What I'm actually getting to now is that my macro models are actually starting to point to us getting into a risk-off inflationary environment coming up here soon. And sometimes that can mean that things, because people will go like somebody said the other week in the comments, like, risk-off inflationary environment. Somebody was on here and they were talking about, Kashop was on here, was talking about bonds. And, there's a bunch of ways to look at it. Sometimes, especially the short-dated bonds. Long bonds, I wouldn't touch them in that type of environment. Sometimes they can move, yes, sure. But the short-dated bonds, that can be an area where you can start to see some movement, mainly because it's starting to go, hey, the Fed has to do this. Hey, the Fed's going to do this. And the market will start telling you that. I don't have buy signals for the short-dated bonds yet, so I'm sitting on my hands at the moment on that one. But the environment we're looking at can absolutely go from reflationary to risk-off inflationary, or stagflationary, as most people call it. And as we're kind of seeing that stagflationary environment, oil and diesel especially can start to see some pressure as consumption start to drop. Now, once again, there's so many things going on here right now that could actually push. This is why Kevin mentioned the 50-50. I also see that as like, hey, like really right here, right now, I would be kind of sitting on my hands of doing anything. Just kind of being ready for the upside, the downside, what we could see going forward. I mean, we have the election coming up. It almost seemed like Biden put a little bit of pressure on Yellen, and they're kind of now going the other direction on loosening to trying to tighten to bring in some better inflationary prints. Now, once again, it's an election year. We're going to see this go back and forth and a tug of war basically until the election. And sometimes you'll just see everything in the market, equities, commodities, oil. They're just going to chop around and be really frustrating at this time. So as a trader, sometimes, you just got to kind of sit on your hands. But looking at it like Kevin's talking about, this environment is a good environment for a lot of things. Sometimes it's not a good environment for oil, though. Oil is very finicky. Oil really likes that growth. It likes that stable growth. And also, more than anything else, it likes a decisive direction in the market. we don't see a really decisive direction. There's not some major, there's risk out there, but there's not something that would say, hey, $100 oil tomorrow could happen. So I think, like Kevin said, I'm still at the same point. I see a 50-50 for oil. Basically, when you're looking at all the commodities, they're still moving nicely. And another one that we could talk about now, Kevin, is the grains. I saw your chart for wheat. I'll pull that up in a second. We had a buy signal last week, or it was 2 weeks ago now, in wheat and corn. And so basically we're looking at the ag market, and now we're starting to see some major movement in the ag market. We haven't seen that in a while. When we were talking about the performance over the last month earlier for soybean meal, and my point of bringing up, hey, that's kind of interesting to see corn, soybean meal, soybeans, wheat, all these things are kind of moving up nicely as we're kind of seeing feeder cattle, lean hogs, they're starting to come back a bit. So, what are we seeing here, Kevin? And we've been talking about this for a while. The grain trade has been the ultimate trade of value in the commodities market. There's been a lot of things that have moved and been out of, major ranges and kind of a little bit overpriced. But when we're looking at these other areas like corn, soybeans, wheat, like they're just getting started. And really, like, that trend could go on for a while. So what are you seeing in the ag market, Kevin?
Yeah, I completely agree with you, right? Like the backdrop here is going into the grain market itself. There is still a fair amount of headwinds. Inventory levels here pretty much across the board, when you're looking at the beginning stocks of this year, are still fairly high. They're still fairly elevated. What the price action or the move to the downside was so aggressive, as you're talking about, that risk reward. I mean, it was prime at that stage here. So what we're seeing now, a couple of developments, right? So we had some weather events that happened like 2 weeks ago that kind of like started this, that started the spark, if you will. We had some weather events here in the United States, a little bit of tornadoes going in through Nebraska. We had frost out there in Ohio. We had a snowstorm here out in Colorado. So that was kind of the initial spark to it. Then we had a situation where India, for wheat, started kind of questioning if they were going to be able to provide and be able to produce enough product in-house within their own country for their own personal consumption. I think people have to keep in mind, India is an exporter when it comes to certain grains, but a lot of grains they actually consume in their own country, wheat being one of them. Rice, certain blends of rice or types of rice they used to export, but now they have an export ban on them because, once again, they had some pressures on trying to produce and be able to keep up with the consumption. Now we're in like monsoon season, so if they're going to have a really healthy amount of rain, that could also push prices back to the downside. But there's still a fair amount of concern that they would actually have to stop some other export of their grains. That also led to the wheat market popping up to the upside. We have bird flu, which is impacting cattle. We had a spaces about that last week. I definitely have everybody check that out. But one thing to kind of also note, it's not the fact that cattle is like dying off from bird flu. That's not what's happening, right? The biggest issue that you're having is milk production for the most part. And then if you're looking for the beef cattle, if you will, right? Maybe weight being stunted for like 2 weeks, 3 weeks, maybe even more. And there's a whole thing about that. But if that is going to be the case, then you're going to have a little bit of a demand when it comes to feeder cattle, right? You got to backfill maybe some of the potential issues. So cattle right now seeing a little bit of a pullback. You're seeing some spot prices actually moving to the downside, but demand is still there. So we're kind of like ranging. Same thing with hogs right now. So hogs are kind of like moving back to the downside. But for grains as a whole, the biggest focus and fear that we saw Thursday, Friday getting into it is the fact that Russia has very dry conditions in certain markets as well. That could also impact the global supply because Russia is a major provider of grains out there. And then the escalation of the Ukraine Russia conflict and the ability to be able to ship out of the Black Sea, and then also the destruction of those farmlands because of the war is also another reason why we're seeing a push to the upside. But here's a key technical level here. All right, so we have that 200. So this is a daily chart for wheat. The 200 day moving average, we failed, broke out. And that's bullish. Now, right now, we are testing a key area of resistance, kind of this price level, 645-ish, that we could reject. That's kind of like that first area of resistance, considerable resistance outside of the moving average. We break above that, we crack 700, Jason. I mean, this thing could rip. And it takes a lot to really try to bring grain markets back to the downside when you're just starting the planting season, because we could have frost, we could have all of this other stuff where it could damage crops, right? Severe winds can actually damage wheat crops as well. So nice little breakout. Once again, we were talking about this before it was cool. We talked about it on the first day of the first video that we did as well, the positioning commitment of traders. This thing has been a long time coming, and there is still headwinds. Don't get faked out. Everybody understands what the headwinds are when it comes to inventory and the price of grains right now. But those key factors, from geopolitical to weather and the risk reward that we've been talking about over the last 2 months, is now starting to come into effect, and you're seeing in the price action.
Yeah, no, I'm just gonna pull a couple things up too, because there's we did a report recently on this, and we've been talking about the grains forever, and I think there's two different things that people have to understand. One is, when we're talking about a setup, and I've talked about this on my channel all the time, when I'm talking about a setup, or Kevin and I are talking about a setup, and we're going, hey, ags, grains, wheat, corn, these things are set up to move. But I always preface it with, I haven't had a buy signal. Now, last week, that's 2 weeks ago now, and it's continued to get more and more buy signals. So basically the way our systems work is we go 50% long, and then we go the other 50%. Now we're 100% long wheat, corn. And so when you're looking at these things, you're going, okay, well, if I'm looking at wheat in a very long-term time frame, and if I pull up a chart, I just brought up another one. If I bring up this chart, very long-term time frame chart, this is a major trend change. This could be a major trend shift. Now, this is making 50 and 100-day highs. That's usually a very bullish sign. It's breaking out of a falling wedge. I'm not the biggest fan of patterns per se, but once again, and like Kevin said, look at that level. Once we get over that 650 level and we start to get closes over 648, now we're looking at a major move in this trend. And a little shameless plug for me here. This is the report that we put out a couple weeks ago. The name of the report is Doing What You Don't Want to Do based on discipline. So, if you guys want to check what our work and make sure, like, I'm not, pulling your leg here, this is definitely the report. And not to mention, you can go back to all the commodity reports. They're all on the YouTube channel. They're all called the Commodity Report. Just go through it week to week. You can see Kevin and I have been talking about this stuff for a while. But really, like, looking at the grains in general, and something that I think people don't understand is the biggest hedge to war over the longest period of time. And we have wheat prices going all the way back to Egypt. If you go all the way back that far and you're a psychopath like me and you want to drive yourself crazy and look at price action that far back and find technical levels or what regime we're in at the time, you can see that wheat prices have been the best hedge for war for many years, whatever war. But once again, we need to have the right ingredients to make that happen. And really right now we do, as Kevin went through, we have the weather issues. We have global issues. We have geopolitical risk. Everything is set up for wheat to be that hedge for war, as it always is. Nobody in the world probably ever called wheat a hedge, but if you really backtest it and study it, you can understand that that's actually true. Wheat tends to move very nicely in those times. Think back to 2022, Russia-Ukraine crisis. Nothing is moving. what could you buy that could make money in Q1 2022? Well, it was wheat. We had I mean, it was an historic run. Now, once again, it's not something that you can stiff your money in a commodity and walk away for 20 years and you're going to make money. Yeah. I don't believe that. I don't do that. But what you can do as a trader is find areas where there are places that there's major moves, major volatility, trades always happening, and that's the commodities market. And so I really like this trade is kind of really playing out. Kevin and I have been talking about this for a while, but the reason why it's been so significant is because these extremes in commercial buying, they've been set up at these major levels for a very long period of time. There's been just about as good of a fundamental setup as you're ever going to see for a commodity for most of the ags for the last few months. But the most important thing is that it's important to see, and that's why I titled it discipline for that one, because the ability to sit on your hands and wait for buy signals is really how you trade well. You can't trade well by just going, hey, like I have a great fundamental setup, I'm just going to buy things. It's not how it works. Mm-hmm. You have to wait because we only get paid on the price action. So the price action is confirming it now. Let's see if we can break that 648 level. That's the level I'm looking at for next to get past that. And then once again, there's no telling where this thing can go after that.
Yeah, and then you can also see from the positioning last week, that managed money was also very offside. I mean, not offsides, right? But they were short. It was a significant amount of short interest across the board. And there's several different types of wheat products that are out there, or wheat contracts, right? There's the ZW, which is like the Chicago. I mean, that's like the most popular one that's out there. You also have, Kansas City wheat, another popular one, and then you have Minneapolis wheat. So Minneapolis wheat is actually really what kind of kicked this thing off. And then it kind of spiraled down that way. But last week, when you're looking at Kansas City wheat, they had 10,800 contract change, net positive change for the contract. Net positioning still at negative 28,201. So there's still a significant amount of short play in the Kansas City wheat. If you look at the main wheat contract, same thing, had 17,790 getting long. Still a little bit of a short interest there. And then Minneapolis wheat, same thing. So yeah, the positioning is definitely there. Just be mindful, once again, it's a weather play. There's a geopolitical play that's out there. And both of those things are very hard to predict. All you can do is look at the risk reward of maybe something could happen. And you can't pinpoint and say, this is going to happen. A week ago, I bring this up, and I'm not going to get into the politics here. So a week ago, everybody was like, well, there is no more war premium, or the geopolitical premiums being depressed because Israel and Hamas are in these talks, right? And they're going to come up with this ceasefire. That literally is basically blowing up in our face over the last 24 hours. And Israel moved into Rafah and started actually taking out targets there, right? Right, wrong, or indifferent of whatever you think about the scenario here, geopolitical things can change on a dime. Last week, everybody was like, oh, all the commodities are going to go back to the downside because there's no geopolitical. Look, things change. And now Israel is saying, look, unless you don't want us to go into Rafah, agree to the ceasefire. And Hamas is saying, if you go into Rafah, we're not going to agree to anything. So they're in a stalemate right now. So guess what? Geopolitical risk is now back on, right? The United States just transferred over in the Ukraine starting today. They'll be utilizing F-16s. A week ago, people were like, oh, maybe this thing's not going to really escalate in Ukraine, and we're seeing a lull. It's escalating. Now you have Macron talking about actually putting boots on the ground in Ukraine. Russia believes that they already have boots on the ground. They might, right? You can't predict what's going to happen geopolitically, but you can set yourself up for that risk reward. If something's at a very depressed level, it's consolidating, right? And a little bit of a base formation. You look at a historical chart on a monthly basis, it's getting to some key technical areas on the short side there. You have the beginning of the season, you got weather events that could actually escalate. You got to look at your risk reward and say, hey, if I'm wrong, what happens if I'm wrong? from a technical standpoint, yeah, it can still go down, but how much further can it go down knowing the dynamics that are out there? Natural gas is the same thing, right? It's a falling knife trade through and through. And we were, you guys got to go back and
It's
watch.
funny because I literally was just about to start talking about natural gas. So I'm glad you said that. I got a chart up just a second ago.
Yeah. So we were talking about it, maybe a month ago or something like that. And I always want to reference the videos, and I don't know the specific dates and stuff, but just go back because we talked about, look, inventory levels are very high. We're going into injection season, but how low can that thing go, right? Like to the point, like natural gas companies are literally not even going to be able to make any type of profit, and they have been reducing their rigs in order to shore up natural gas prices, and they're not going to try to output as much and all this stuff. But when we talked about it, it was like we were 8 cents away from all-time lows on the contract, like what, or 10 cents, something like that, right? It was like $1.66.
It was at 2020 levels.
Yeah. So it's kind of like, how low do you want to go? Now, we talked about the structure of that trade, right? You just don't go all outright long natural gas. But I brought up the example of not a recommendation, but if you actually did buy that November contract, remember I was talking November, you bought the November contract and then you sell premium against it until you catch a bid, because between now and the middle of summer, it was going to spike. That everything is saying it's going to spike because super oversold, geopolitical risk that is out there, maybe a hot summer out there for utility companies may have to raise all of this stuff. And it's like, how low can it go? Now, would you go long natural gas here, Jason? That's my biggest question.
I'm already long. I've been long. Well, so I talked about it a month ago. It was probably a month ago, and our position went long, and it just chopped around forever. And I kept saying, like, to me, certain traders will have things like time stops and whatnot. I just don't have time stops. I don't think that way. I'm not sure if that's like, for me and my time frame, I don't think it makes sense. Shorter term traders, day traders, even weekly swing traders, things like that make sense for me. I can sit on my hands for months and just watch this thing chop around sideways. If I don't hit my sell exit level and I don't hit my stop loss level, I'll sit in the trade. So we've been long it. Now it's starting to make money. I mean, it was underwater for months. Basically for me, like, I don't buy lows. So, it broke out, and then it didn't touch that level for another month straight. Now it's moving nicely. I mean, we've made some money on the trade at the moment. So it's a good trade now. But once again, for us, we have a system, and it's a false breakdown system. And basically what that means is when you see that level, like, look at where the red line is. So there's a certain amount of days that our system is that if it's over a certain amount of days and it makes a new low and then goes above that low, you get a buy signal. So where this that pullback was basically when it broke down in the beginning of this year, it bounced probably in February and cleared that level. Now, this is a line chart, so it's weekly closes. So you're not going to see what happened day to day, but it did break that level. And then it came down for a month and a half and just chopped around. Then finally, it makes it back up to the upside. Now it's kind of trending nicely. We'll see where it goes. But once again, it's like natural gas is, so many people call it the widowmaker trade. And I think it's important to also say, like, anything could be the widowmaker trade. Bitcoin could be the widowmaker trade. I'm sure more people have gone broke in the last few years trading Bitcoin than natural gas because nobody trades natural gas. Some people trade the ETF, but the futures and really using leverage and stuff, it doesn't happen like it used to back in the 70s and 80s. So it's not the widowmaker trade, but also what's important to understand is the volatility of this product is high. My stop loss has to be over 30% most of the time. This market is extremely volatile. So if you're looking for those major trends, your stop loss is going to be really wide. If you're looking for a short-term swing trade, You got to be very tactical, but also over everything else, because your stop loss is so wide, your position size has to be smaller. It's something that a lot of, like, if you talk to a professional trader, they could talk to you about position sizing and all that stuff forever, and you'll be bored to tears. And I could be on this channel all day talking about that stuff, because to me, that's what makes me money. The analysis, the buy signals, the sell signals, all that stuff, that's all very important, but it's not nearly as important as, hey, I took the trade. Hey, I'm at this size because this is a very volatile product. If you're looking at it, using 3% of your overall portfolio as a position for, $100,000, you use $3,000 of your portfolio for something like that, because you have to run a stop so wide that if you only want to lose 1% of your portfolio, it can only be $1,000, around $1,000. So once again, like, understand the volatility of this product. It's crazy volatile. Most commodities are. Natural gas is far above that. So, talk more about, position sizing, and understand what that means, and understand the volatility of the product. But looking at natural gas, we have the signal, and I've seen this many times where everybody's against it. They're going, it's the end of natural gas, like, we're going to move to some different type of energy going, and it's ridiculous right now. Like, natural gas is just growing and growing. The problem is that it's so easy to get natural gas that there's always an oversupply of natural gas. So, but once again, it leads to these massive spikes at times and these massive trades. So I think it's a great trading vehicle. And so we're long it. We're still going to be long it until I get a sell signal, and it's nowhere near that now. Now it's trending. I don't doubt it has a pullback, but once again, people look for breakouts. Going back to that chart real fast for 1 second. Going back to breakouts, this is a false breakdown signal. So we broke out of that level finally. And most people will go, oh, well, it's going to come back to that level and maybe bounce. Do not look at commodities that way. That will kill you. Commodities,
especially natural gas.
Yeah, especially natural gas. It's not going to come back to any logical level and bounce or do something that makes a lot of sense. It's going to either break out here and just continue to rip with minor pullbacks, or it's just going to break down and start falling like crazy. I wouldn't look for major levels here. I wouldn't say, hey, it can go here. I think, the only edge I've ever found trading natural gas has been to build systems. You build your system, you take the trade, you take it based on price action, you run a trailing stop, and you get out and take small positions. So that's the best advice I've ever gotten on natural gas, and I hope to pass it forward and other people can use it as well.
So I'm looking at the spread. So looking at the spread between June and July. So I like to do this every once in a while when we see these spikes to see if this is legitimate or not, if this is just a near-term situation. So you take a June contract minus the July contract, whatever the spread is there. It's pretty much still trading in contango now because of the season. And so I try to see, is that spread actually like getting tighter, right? Is it a tighter spread or is it a widening spread? And right now, when I look at that spread right now, it's for the most part getting tighter.
Mm-hmm.
So what does that mean, right? So one, June hasn't gone over July yet, right? Which is good, right? So you're seeing bullish action in a contango market, meaning you're seeing bullish action in a normalized market. If we were seeing just immediate front month demand, we would see backwardation where the front month is priced higher than the future month, right? So if July was priced lower than the June contract, we're not seeing that. You're still seeing that contango spread, which is a good thing to say the least. Backwardation is decent if you're doing like a spread trade for natural gas, right? If you're doing a spread trade and you see that backwardation occurring, you sell the backwardation 9 times out of 10. Because what's the likelihood of natural gas staying in backwardation for 4 months, 5 months? Highly unlikely.
Yep.
Right. Even for a month, highly unlikely unless we have like a 3 week winter period happening or something crazy happening, or we have a Russia-Ukraine conflict type of situation. And it's not all conflicts. That conflict was specific because there's pipelines, critical pipelines that's going through the Ukraine to fuel Europe, right? That's what caused that particular situation. But that's already kind of like abated here. So I think the spread is showing that there could be some more room for the upside for Natty. I always just go back to the fact inventory levels are expected to go up because this is injection season. If we do see an inventory buildup within crude oil and operations still go, natural gas is also going to see a buildup as well, right? So keep that in mind. Short-term trade, very volatile trade. Spread is still looking decent right now. You're still in contango. It means the market's not. That means the whole curve's feeling this is feeling the at least the first three contracts are feeling the love instead of just the front month. So.
And that's also one of the first things I noticed about Kevin. You know, when we were talking at the beginning of this year, you know, there was a big bounce in natural gas one day. Was it 22% or something crazy? Huge like single day move, and everybody was, you know, trying to buy it and saying it was time to buy, but the spread was insane. There was no, basically I remember the front month was up like 22%, and if you went down to, I think the summer, I think it was the August contract, if I'm right, the August contract was only up like 2%. So it was like the most ridiculous, like there's no way this is sustainable type of trade. Kevin was the first person to kind of talk about that. So, you know, definitely listen to what Kevin has to say on the spread idea. But, you know, I wanted to talk about this before we go. There's a good question on here. So it said, great stuff. Thank you for the compliment. Thanks for tuning in. There's some disruption coming for gas as batteries start to ramp fast on the grids. Look for more glutting. So, you know, I'd like you to talk about that, and then I'll talk about it. You know, we'll just keep it like a minute each because I know you got to go at the top of the hour.
Yeah. Thanks for the comment. I would ask for like a little bit of a clarification. Maybe we could hit it on the next one. But the gluts that are happening in natural gas right now is just because of the abundance of supply that we have here in the United States. And it is a byproduct of the shale production or shale boom. Now, when you're talking about batteries being put online, that is true. We are seeing an increase in batteries being long-term storage batteries, right, being implemented within the grid. So that is a thing. I think what you're also seeing, though, in the natural gas trade right now is a lot of institutional papers and a lot of research studies are starting to drop around artificial intelligence and its need and its use for energy. If we actually did fully scale up to what we are seeing as far as the purchases or the expected purchases from NVIDIA and all of these names and all of the hype in the CapEx spend, if that were to be a case, the draw on the energy grid might be something that we don't have capacity for right now, right? And so there's a thought that natural gas demand will also actually go up because of the AI story. And then also natural gas going up in the event that we do see a reversal on LNG terminals being built out here in the United States. And I'm not going to don't use this as a trade. I would assume eventually we will see those LNG terminals, those approvals starting to kick in really quickly here. And it takes a long time to be able to build that up. But just understand, we are the supplier for Europe for the most part, us and Australia. If something were to go down and we do see an escalation on the geopolitical front, and France actually does do what it says it's going to do and pulls NATO in, right? You could say, Europe can say bye-bye to all natural gas coming from Russia, and they're going to need to have that supply. So I think even no matter if you're the most ardent environmentalist out there, strategically, from a geopolitical standpoint, it kind of forces your hand to actually increase those LNG terminals. That would be bullish for natural gas. So I think you're spot on in some respects, but just that breakdown of the AI boom is giving a lot of. That's also why we're seeing utilities pop too, right? Like utilities have actually done phenomenal over the last couple of weeks, low beta and outperforming a lot of sectors. But that's also the thought process there that they're going to be able to have some pricing power in the long term, next 3 years, 5 years.
No, great. I mean, we had some great comments. So thanks for the compliments, everybody, Beth. And I don't have a name there, but you know who you are. question we're answering right now. But when we're looking at that for me, so it's once again, there was somebody who said something. There's been a couple things that have happened on my page lately. You had it was Jeffrey Hirsch and I were talking about solar energy, and people, instead of looking at it like, hey, like, these guys are trying to talk about trading, they were very upset about, the opinions we had, because it wasn't about, saving the planet or something. Now, once again, what we were trying to say there and in that video, and now what I'm trying to say now, is that to get to the place where they want to get to, where Agenda 2030 or whatever these agendas want to get to, there will be a lot of natural gas. There will be a lot of copper. Not to mention, it's not like, you charge your car and it runs on air or something. You have to charge your car using natural gas. At the moment, there's still a lot of coal energy being used. So it's kind of there's another comment. Solar and storage are cheaper than gas now, and the more we scale it, the cheaper it gets.
I'm sorry. Let me just cut in there real quick.
Yeah, please.
I would say in some respects you are correct. The thing that you have to also though keep in mind is the fact that we probably will continue to cut the access of any solar panel technology that comes out of China. That was actually a big deal a couple of years ago, which could actually still increase the prices. There's been a lot of ways that solar companies have gotten around some of these bans or these embargoes, right? So you're in a sense, on a scalable standpoint, you are correct. The implementation of those systems, though, are still fairly costly, but over time they will be more cost effective. But the initial outlay of cost, especially if you're looking for U.S. domestic produced solar panels, are still fairly high relative to us utilizing natural gas. If we drop the solar stuff for China, if we say, hey, China, you guys are our best friends now, give us all the solar that you can. Oh yeah, solar prices would. It would be night and day. You would build solar farms from here all the way up to Nevada. I'm in Colorado. We would just be lacing the whole thing. But the produced solar panels here in the United States, or for our allies that we actually import from, are still fairly expensive from the labor standpoint.
Yeah, I mean, it's just, when you look at it, it's not about whether take the politics out of it or what we believe out of it, because, we all have a lot of beliefs. It's mainly what is practical, what exactly makes sense, how long would it take to get from point A to point B. All of these things are going to take a lot of time, a lot of effort, and a lot of energy. And this could still be part of the trade at the moment, because I had somebody tell me the other day that commodities are going to be done because we're going to move to this new energy system, and that's going to be the end of commodities. And it's like, you need commodities for all of these things. All of these things still need commodities. I mean, your car, even if you have a Tesla, it still uses a lot of commodities. Still even uses oil. Your tires are oil. Paint is oil. So basically, you have to be able to kind of look through these a little bit and understand that, especially in the short term, if we're just talking about trading. This question, we could get to the philosophical part of it at some point. That would be cool. We don't have time today. But just as a trader, for me, it's like, let's look at it in the short term. You can see these major bounces. You could see some major moves in these things in the very short term. And so I think it's a very good time to be looking across the commodity space, continue to follow good analysts, continue to look at the charts, look at the price action, the performance, and see how you can benefit and create wealth for yourself in these areas.
And then I do have to jump here. The EIA has a lot of great data on solar. And understand this, I am a huge proponent of it. I have panels in my house, and I wish I would have doubled the amount of panels I have. The thing that I will say is that there's a lot of people that are down on solar right now, but the commercial side of solar is still booming. It's booming at a very rapid pace. Commercial production or commercial installation continues to ramp up at a very healthy clip. The residential side has fallen off a lot, which is why we saw a lot of pressure for like the TAN ETF and Enphase and all that stuff. But the commercial implementation continues to go at a very robust pace. So check out the EIA.gov, and then just look up their solar data. They have just phenomenal reports on it. And they also have good reports on wind generation too. There's another misconception that I believe a lot of people, especially on X, are like, oh, like wind production, it's BS, it's yada yada yada. And it's like wind production continues to is starting to increase faster than any other energy source in the United States.
Yes.
So what we say from a political standpoint, and if you think that they cause cancer in the head and all this crazy, no, I'm not going to call it crazy, but if you believe in those type of things, I would say just completely do your research. Wind turbines are not falling off a cliff at all by any stretch of imagination, and it's here to stay. It's just going to take a long time for it to be up and running, and then the battery storage is also a key item. But all of that stuff needs raw materials. No matter what renewable energy source you're looking at, you're going to need the fossil fuels in order to make it happen.
Yeah, I mean, and we're going that direction. That's the thing about it. We are going that direction. I am not against any of that at all. I'm just talking about it as a trader and trading.
Yeah.
It's not that, we're not debating like, hey, this is going to be good for the earth or not. That's not what we're debating here. We're just talking about how to generally trade this market because of the dynamics that are coming forward. Because really, like, we completely agree with what Leap is saying. Every single thing is pretty spot on. It's just how do we trade it? How do we position ourselves through it? And, that's what we do here. So, all right, Kevin, I know you got to run.
Yeah.
Coop,
always a pleasure,
thanks so much for joining us.
For sure, man. Let's try to connect later this week, but I appreciate you.
All right, man. You take it easy, Kevin.
See ya.
Leaps. Leap, I'm gonna give you my handle for Twitter, and then you can see Kevin's on there too, so you'll get that as well. So here you go, Leap. All right, guys, thank you all so much for joining us. We'll be with you every week at around 11 or 12 a.m. We've been doing it around 12 a.m. a lot, but 11, 12 a.m. some days it's a little bit earlier. Kevin has a very busy schedule, so we just fit it in where we can, but always between 11 and 12 a.m. Coop, Beth, Leap, thanks for joining us, and we'll see you guys next week. Also, we have a show on Friday, the Market Report. Please join us then, and we'll talk to you later. Leap, I look forward to seeing the data from you as well, man. Take it easy.